The US stock market value has changed a lot over the last 2 years. The Standard & Poor's 500 fell sharply during the early phases of COVID, then went on a growth spurt to new highs, and in 2022 has dropped back a little. The question many of us are asking is the stock market overvalued or undervalued? An extremely complicated calculation this might be, especially as we can't predict the future. However, there are a few indicators that we can look at. First up, let's look at the Buffett Indicator. The Buffett Indicator was a metric created and put forward by the famous investor Warren Buffett. He called it probably the best single measure of where valuations stand at any given moment. If we take a look at the website currentmarketvaluation.com, it states that the Buffett Indicator is the ratio of the total United States stock market valuation to GDP. Another way to say this is the total value of US stocks divided by the size of the US economy. For this, he uses the Wilshire 5000 index. If we scroll down on the page, we can see both a figure and the current values and analysis. According to current market valuation, the Buffett Indicator is currently 33%, or about 0.9 standard deviations above the historical average, suggesting that the market is fairly valued. Even though the exponential trend line is 127%, the 169% now sits within one standard deviation and is fairly valued. Now let's look at the stock market price earnings ratio. The PE ratio is a common metric used to value stocks, and we can look at the whole market with this indicator too. We're looking to see whether it is significantly higher or lower than its average. It's worth checking out a few sites for your ratios, as data and calculations can vary between them. If we look at multiple.com, we can see that the current PE ratio is 19.33, which is above the mean of 15.97 and median of 14.89, suggesting that the market is overvalued. If we also look back at currentmarketvaluation.com, again we can see they have a few different figures. It suggests that using the cyclically adjusted price earnings, or CAPE ratio, is more useful. They say the indicator currently shows the current S&P 500 10-year PE ratio is 28.7. This is 43% above the modern era market average of 19.6, putting the current PE 1.1 standard deviations above the modern era average. This also suggests that the market is overvalued. Now let's look at Tobin's Q ratio. This ratio is found by dividing the market value by the replacement value. Again, opinion differs on how effective this measure is, but the idea is that a value over 1 suggests that the market is overvalued and under 1 suggests it is undervalued. One site that we can see this metric on is ycharts.com. The last measure in March for Q1 2022 was of 1.598, showing at this point the market was overvalued. It is also important to look at the historical means. The mean average in the 10-year period from 2010 to 2019 inclusively was approximately 1.35. So again, the current value of nearly 1.6 is well above this. The last method we're going to look at today is of mean reversion. This method of valuation is quite basic. It assumes that although stock prices can be volatile in the short term, they will generally revert back to a mean average in the long run. Currentmarketvaluation.com shows us the S&P 500 is currently 31% above the modern era trend line. This is suggesting that the market is currently overvalued. In terms of further metrics, on the site currentmarketvaluation.com there are a few other valuation metrics to look at, including yield curve reversion and interest rates. Morningstar also has a market fair value ratio, and you could also look into other ratios such as the market price to sales ratio. In summary, all indicators have their flaws, and the stock market is extremely hard to predict. Timing investing in the market is extremely complicated. Using the indicators in this post suggests that the market is overvalued, but any indicator predicting the future of the stock market has to be taken lightly, and we certainly shouldn't take this as a reason to sell all of our stock portfolio. We don't provide financial advice, so please do your own research before using tools discussed on this channel.